Here's a question for you. Do you want the lowest interest rate on a mortgage or to pay the least amount of interest? Hey there, welcome back to Prairie Real Estate. My name is 𝗤𝗲𝗍, real estate agent in Regina, Saskatchewan. That's my trusted assistant, Matilda. So if you have the lowest interest rate, you would then pay the least amount of interest, right? Not always the case. When I do my weekly news recap videos, I go through the best interest rates available that week, and I say the lowest interest rate isn't always the best mortgage. And that had a viewer ask me, why do I say that? And guys, please keep giving me these questions to make videos on. I'm really enjoying doing it. So here is that viewer's question. The question was, how could the lowest interest rate not be the best mortgage? For them, the lowest interest rate mathematically was going to be the best mortgage, and they didn't understand why I would disagree with that. So let's talk about it. But of course, we cannot start another Prairie Real Estate video without one of my terrible bad dad jokes. So if you're attacked by a group of clowns, what should you do? You go for the juggler. If you have a terrible joke, I can use it for future episode. Put it in the comments below. Let's answer this viewer's question. The interest rate on a mortgage is simply just the cost of that mortgage and nothing more. Imagine this scenario. You're going out shopping for groceries and you need a bag of apples. But the only tool you are allowed to use to make your decision on what bag of apples to buy is the price of the apples. You don't have any idea how many apples are in that bag, what the quality of those apples are, maybe some are rotten, or even what type of apples they are. Are they crab apples or Honeycrisp apples? You wouldn't make your decision to buy the apples on simply just the price and no other information. I'm gonna lay out an example here where both Joe and Jimmy are buying a house. They're spending $700,000. They're gonna put 10% down, and they're going to have a 25-year amortization. For this example, I'm gonna fix the interest rates for the entire 25 years just to demonstrate what I'm talking about here. Joe went and got his mortgage from 𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏 passing interest rate, 3.99, means his monthly mortgage payment is about $3,400 a month, and he's going to pay approximately $366,000 in interest over the 25 years. Then you've got Jimmy, and he went to his local mortgage broker who gave him an interest rate of 4.25, which even still today would be pretty good, but that means his monthly mortgage payment is $3,500 a month, and he's going to pay approximately $390,000 in interest over 25 years. Clearly, Joe's low interest rate is better, right? It is better, right? The answer is, well, possibly, maybe. This is where we have to get into talking about the quality of the apples. I mean, the mortgage. And I've got two examples here to show where potentially a lower interest rate would not be a better mortgage. The first example we've got here, Joe and Jimmy both got a fantastic promotion, but they're going to have to move, meaning they're going to need to sell that house. Right now, they've only 2 years into their mortgage, meaning there's 3 years remaining. But Jimmy has what's called mortgage portability, meaning that he can pick up that mortgage and apply it to a new property. He's got no penalties to do so, so it costs him $0. Joe, with his no-frills mortgage 𝗳𝗲𝗍 ultra-low interest rate mortgage, doesn't have portability, meaning he only has 2 choices. The first one is he doesn't take that job promotion because the payout penalty would be too expensive, and we're seeing that right now in our market today. There are homeowners that would like to move up or move to a different city, but they're choosing not to because the payout penalties, or they can't transfer that ultra low interest rate to a new mortgage, mean it would be too expensive. And so then they're not moving. Starter home buyers now are stuck with less opportunities because those move up buyers haven't moved up into a different house, leaving that starter home available for them to purchase. Do you want me to handpick a great real estate agent for you from my network of agents across the country? In the description of this video, you're going to see a link to my calendar where you can book me in for a call. I'm going to learn about what's important to you, an agent, and then get you the perfect agent to help you find that great house. When it comes to payout penalties, it's tough to say exactly what a payout penalty will be because there's a large number of factors that play into how much that payout penalty could ultimately end up being. What I did though was I ran this scenario by a bunch of different mortgage brokers to kind of give me a range, and the numbers that came back for Joe was about $18,000 on the low end to break that mortgage to potentially as high as about $55,000 on the high end. So that means with just one move, all of the savings that Joe had, he was saving about $27,000 in interest versus Jimmy, is wiped out. Being able to pay your mortgage off early, otherwise known as prepayment, is a very powerful tool that you as a homeowner can use to reduce the amount of interest you pay and shorten the length of time it takes you to pay off your mortgage. Unfortunately for Joe, his no-frills mortgage .ca mortgage doesn't allow him to prepay at all. meaning that $366,000 in interest he's going to pay is set in stone. But Jimmy, on the other hand, has the ability to prepay his mortgage, and he chooses to pay $150 per month or $1,800 a year in addition on his mortgage, and that drops the amount of interest he was going to pay from $393,000 to $360,000, shortens 2 years off his mortgage, and saves him $6,000 more in interest than Joe saved with that lower rate. Bump that another $50, $200 a month to make it $2,400 a year, and Jimmy goes from paying $393,000 in interest to $350,000, or $16,000 less than Joe did, even though Joe had the lower interest rate, and Jimmy pays his mortgage off almost 3 years faster. Yes, I understand in this example, I'm asking you to pay more per month for your mortgage, which may not be an option for you, or you want to allocate those resources to a different investment opportunity, which may yield better results. But for the purpose of the example, I'm just trying to demonstrate the lowest interest rate does always mean the least amount of interest paid over the course of a mortgage. These are just two examples of where the lowest interest rate may not be the best or the cheapest mortgage in the long run. Often these ultra low discount mortgages aren't what's called fully featured, or they could be very restrictive, limiting your ability to port that mortgage or prepay it early, which, as we've seen, could save you a significant amount of money. Personally, I like the flexibility of being able to prepay my mortgage early or move that mortgage if I wanted to do so. But it doesn't mean that's the perfect situation for you. If you're going to go with one of these low interest rate mortgages, just understand what the potential restrictions could be. And if you're okay with that, that's fine. Go with that mortgage. Just make sure you know exactly what you're signing up for when you get that mortgage, so you don't have problems you didn't know about later on in the future. If you're new here and haven't seen one of my weekly news recaps, well, get subscribed so you don't miss that video, and this is my most recent one. If you like this video, please give this video a like, and as always, thanks very much for watching.